Let's go ahead and get started. Welcome, everybody. Good morning, afternoon, evening, wherever you happen to be in the world. Welcome to this workshop, which has been a very popular workshop at past Resi conferences, hosted by our friends McDermott, Will, and Emery on negotiating term sheets, something that is of interest to everybody who's raising money. And I would like to pass the mic over to Mark Mihanovic, because he will be moderating the session. And if anyone has questions, please type them into the Q&A chat box, and they will be addressed towards the end of the session. So thanks very much, Mark, all yours.
Thank you, Greg, and thank you to everyone for joining us for the term sheets workshop. As Greg mentioned, this workshop is intended to provide guidance to entrepreneurs and to senior management of early stage companies that are going to be in the process of negotiating term sheets, anticipated to be in the process of negotiating term sheets, maybe already in the process of negotiating term sheets. My name is Mark Mihanovic. I'm a corporate transactional attorney, and I'm the partner in charge of the California Transactions Group of the McDermott, Will, and Emery law firm. I also head up McDermott's emerging companies and venture capital practice. As Greg mentioned, I'll be moderating the outstanding panel we have gathered to discuss term sheets over the next hour, and we have panelists from both perspectives of the company side and the investor side. So I'll start with some brief introductions. Nancy Briefs, the President and Chief Executive Officer of Altrix Bio. Altrix Bio is a preclinical stage therapeutics company with a platform technology for metabolic disease. Nancy is a serial entrepreneur with experience in medical devices, pharmaceuticals, and digital health. She's worked with 6 companies previously that raised more than $500 million, including one that she took through an IPO. John Demeter is the general counsel of Khosla Ventures, a prominent Silicon Valley-based venture capital firm. John joined Khosla in 2016, prior to which he had represented investors and entrepreneurs in hundreds of transactions in private practice. John serves as an adjunct professor and guest lecturer on the topic of venture capital transactions at numerous Bay Area law schools. David Hendren is a managing director of Augmentum Advisors, a consulting, business advisory, and management firm that advises and partners with entrepreneurs, startups, as well as more mature companies, and with investors, as well as R&D organizations, deal sponsors, and management. David began his career as a corporate lawyer and has leadership roles on all sides of the table, including as venture capital investor and as the entrepreneur and CEO. And then Aroma Sharma is also a partner in the Silicon Valley Transactions Group of McDermott, Will, and Emery. Aroma focuses her practice on a wide range of corporate and transactional matters, including acting for emerging companies and equity and debt financing transactions across industries, including technology and healthcare and life sciences. So again, we can have this session be interactive. I will try to keep tabs on who's asking Q&A in the chat, and may interject as we go, but we'll certainly save time at the end for questions as well. We're going to start by spending just a few minutes on general comments on term sheets and on the goals and purposes of term sheets in a venture capital transaction in which there's investment in the early stages of a company. First, it is important to note that there are different philosophies and not necessarily one size fits all with respect to term sheets. Some of you might have heard of the NVCA, or National Venture Capital Association, model forms. These forms include a form for a Series A preferred stock term sheet, which can be a good general frame of reference for entrepreneurs, for people raising money, with annotations that explain various terms and provisions. But many venture capital firms use their own term sheet forms, and these forms can differ from VC to VC, including in terms of length and level of detail. A general purpose of the term sheet is to set forth the basic business, economic, and structural terms of the proposed investment. This allows the company and the investor to assess whether or not there is general high-level agreement on transaction terms prior to incurring the expense of performing due diligence and drafting and negotiating and finalizing definitive documentation for the investment. We'll walk through some of those basic term sheet terms that are deal related shortly, but generally these terms are expressly stated to be non-binding, with the only binding terms being separately covered and called out, including typically an exclusivity provision, whereby the investor will say, I want 30 or 45 or 60 days to do my due diligence and negotiate the deal before you can talk to anyone else about a potential investment. Perhaps generally a confidentiality provision and some expense reimbursement provisions as well. From the company's perspective, a nugget of advice would be to make sure that the expense reimbursement provision obligation doesn't get triggered, and which you can try to cap, by the way, but doesn't get triggered until closing of the deal, so you don't have a situation where you're paying the out-of-pocket expenses for an investor without closing funds with which to pay them. The discussion today, though, is going to focus on the terms of an initial price equity Series A round. Before we go there, though, I'm going to actually ask Aroma to spend a couple of minutes on pre-Series A or seed rounds, including with respect to instruments such as convertible notes or safes. Aroma, can you do a little bit of background there?
Yeah, definitely. So whether a financing round is considered a seed round versus a Series A really depends on a multitude of factors, including the size of the round, valuation and price, and who the players are. That being said, a lot of this depends on a particular company and where they're at and where they want to go. But generally, a seed round involves a smaller group of investors, and the funding is used to support market research or early product development. There's a focus on really financing an entrepreneur's upfront capital requirement versus a Series A round, generally trying to fund companies that are a bit further along. Oftentimes the funds are used to further support product development and initial marketing. And investors look at companies that are potentially have completed the business planning phase or have had previous seed financing rounds. Ultimately, what matters more at this stage, I feel, is that you get the terms right. Oftentimes, future investors are going to look at these early stage investment rounds as a precedent for your future financing rounds. And it's really rare that you're going to get better terms down the line than your first true financing round. So oftentimes companies will consider convertible notes or safes early on instead of a true preferred equity round. Safes are an alternative to a convertible note, and it was introduced by Y Combinator several years ago, and it's supposed to be a simple agreement for future equity. And investors may be open to these terms as an investment mechanism, especially if there is signs that there will be a true Series A round shortly down the line. And if they include investor-friendly terms like valuation caps or discounts. And I just want to note that in convertible notes and safe rounds, the investors are not stockholders, so they don't have voting capacity in the company. And an advantage is that it sometimes pushes off the need to determine a valuation at that time. And I think the rest of our panelists here will speak a little bit further about valuation.
Yeah, let's start with that. I mean, one of the most important, perhaps the most important term of the deal, the pricing of the deal, is key to the company valuation. If we can start with Nancy. Nancy, how do you think about determining the right valuation for your early stage company and the negotiation process to get you there and the implications of that valuation?
Thanks, Mark, and good day to everyone on the conference here. I think it's important when you think about valuation that you understand the total capital that you think you're going to need to get either to an exit or to commercial, and then lay that against milestones. So I always say that the valuation should be like a stair step. You want the valuation to continue to go up so that you're increasing the value for all of your stakeholders. So what I typically do is I look at market numbers, things like what were the valuation of potential competitors, which you can often get from PitchBook, or look at Silicon Valley Bank. They have a number of great reports on, in general, different series and what the pre and post were, so you can get a range so that you know. And I think that, as Aroma said, the Series A investor are the very best terms you're going to get. So evaluation is important, but also you'll hear today about other aspects of the term sheet that could be just as important down the road. So that's kind of how I think about valuation.
John, the same question from the venture capital firm perspective. Can you walk the audience through pre-money and post-money valuation and the calculation methodology to determine valuation?
Yeah, sure. Absolutely. How's everybody doing today? Thank you for having me here. So I agree with everything Nancy said. I can tell you strictly from the investor's standpoint, when an entrepreneur or group of entrepreneurs comes in, and we're usually the first institutional or outside money in a company, and they say, hey, we have a world-changing product and we need $3 or $5 million, whatever the ask is. On the investor side, we will immediately say, okay, if the ask is for $5 million, number one, do we want to invest? And number two, how much of the company do we want to own for that $5 million? And that simply becomes a math equation of, the minimum we need to own of this company is 10% to put somebody on the board, to occupy our partner's time, to help build and grow the company. And so if the ask is $5 million and we need to own 10%, that tells you that your pre-money is 45 and your post-money is 50, right? And it becomes as simple as that. And so from our perspective, we never look at an early stage company and value it based on the market size they're trying to go to, or even some of their competitors. It is somewhat a function of the cash ask of the investor divided by what percentage of the company we need to own to make it interesting.
David, when you're talking to founders, what do you advise as to how to deal with the tension versus alignment regarding founder and investor incentives in the context of valuation? There's a tension, there's an alignment.
Right. So great question. And I would go to a little bit of both what Nancy said and what John said, because it's really important to understand how each side of the table looks at the process. So what John was saying was not necessarily here's what we're putting in and here's how much we need to own, and it's 45. He's saying there's a cap there, okay? Because his job is to own more of that if he can. And as Nancy said, you got to think in terms of how much you're raising at a particular time and what that's going to mean in terms of accomplishment of particular milestones. A lot of folks look at the fundamental issue of how much they're asking for without reference to what you're looking to accomplish. And that's really what you need to do to talk both in the investor's language and to fit things into a context of what you're looking to accomplish with particular amounts of capital. What was talked about earlier with things like seed rounds and these, what constitutes a seed round versus a Series A has evolved a lot. Series A rounds have gotten a lot bigger than they used to be. And at that early stage where it's really hard for everybody to get comfortable with what the pricing is going to be, but you put in a tried and true mechanism like a convertible note that has a discount to a round and a terminal cap on it, you then can fit that into a priced Series A where you're saying, okay, here are the particular milestones we're looking to accomplish in terms of, and it varies by industry. I mean, in Nancy's industry, you can go through a bunch of rounds of capital. And for those of you who weren't paying attention, in the regulated space where you need to get something through scientific validation before you can sell it, obviously you don't have revenue. So you can get to a B or a C round without having sold anything. So you need to think about the context. But the point is that some of it's defined by market forces. What are comparables, as both Nancy and John related to? How much do the investors need to own? The key takeaway I would give for people on the entrepreneurial side of the table is the whole negotiation of a term sheet is one of your first interactions with your investors, and you're able to test your working relationship with them. And in terms of valuation, you got to be close enough for horseshoes and hand grenades. It's not an exact science, and it's not one where you sort of, these aren't public stocks where there's an established price. It's what a willing buyer will buy for and a willing seller will sell for. And that's defined by some comparables and as John said, what the investor needs to own. So be close enough, and as an entrepreneur, have the confidence that if you're off by a little bit, it's not necessarily the hill you want to die on. If you're dealing with Coastal Ventures and they're offering you a little less of a valuation than some controversial firm that you never heard of, you go with the established firm that's going to add value and help take you to the promised land. And also, if you're a little bit off in your valuation, a smart investor like Khosla is going to make sure that you, as the entrepreneurs and the founders, continue to have your options refreshed so that you're not falling outside of a range of your incentives. So it's not an exact science. That's the key thing. Do your homework to understand what other people are getting. Understand what the investor needs to have, and then go at it in a way that's very conversational. It's not about ego, and you can blow up a deal with a good investor by getting too cute about valuation. Is that helpful?
Very helpful, David. John, in the valuation exercise, you spend a couple more minutes on how the investor counts equity incentives.
Sure.
Are you looking at the full pool? Are you looking at that which is granted, whether or not vested? How do you count it in the valuation?
Yeah, so I think very much piggybacking on what David said. There are hills to die on as entrepreneurs and investors, and ones not to. And even before getting to the incentives, because this is one I think that's important for entrepreneurs, is the level of dilution you will take in your first round of financing. But I will make a quick plug of the less issues that are on the table to even be discussed, the better you look. So having entrepreneurs come in saying, I'm fully vested and I won't revest, or I want 10 votes per share of common stock and I want the investors to have 1 vote per share, or all of that, sometimes it happens, but focus on what's really important. You want to get a good partner. You want to align incentives. And so, let's worry about valuation and dilution and board and voting control from both an investor and an entrepreneur's perspective. So, if we have 3 founders, or I'll use 2 because it's easy math, 2 founders, and they own the company 50-50, and they walk in and Khosla says, we love you. We want to write a $3 million check and we're going to own 30%. So that's a pre-money of 7 and a post-money of 10. You think, great, my company's worth 10 million. And then we say, well, it's just the 2 founders, and we think you need to hire a really big team. You need scientists, you need technology development. So we want to put in a 20% option pool to help incentivize and help you hire, because you will be cash poor but equity rich, and equity is your most valuable asset in attracting and retaining talent. So you say, great, 20% sounds great. The issue quickly becomes that we co-loan 30%, and you have a 20% option pool that, from our perspective and most investors, it's not going to dilute us. Our money's going to help build the company from this point forward. So you two founders who each own 50-50, you now own 50-50 of 50% or 25% each. So you took basically 50% dilution at the outset. And there is no way to sugarcoat it or make it easy. And this is part of the negotiation. So you try to push us up to 11 or 12 million as a valuation to bring our percentage down. The option pool piece, I will just tell you, it is, I would push on the valuation more than the pool. You're always going to need more pool. You're always going to need more available equity to hire people. So I would not focus your battle there. I would focus on the valuation piece in arm wrestling with the investors. But that's a lot of dilution, and it's like a jump in a cold swimming pool. And the one thing I'll loop back to that Aroma started with. So you'll see sometimes people say, well, I don't want to deal with that now, so I'm going to do a safe, I'm going to do a note because I don't have to deal with it. Well, you kind of do, because a lot of those have a valuation cap in them. And I've seen entrepreneurs time and time again say, I sold $500,000 of safes at a $3 million cap. Then I sold another $500,000 at a $10 million cap. And I sold another $500,000 at a $15 million cap. My valuation is going up, up, up. And then when you see that how, with those caps, all of a sudden you end up in an equal, if not worse position when you go to your first round. And I've seen entrepreneurs start out with 100% equity and end up sub 10% after a Series A because all of these safes that they've sold. So, not to mix metaphors, but, always work with good advisors who can advise you on the math aspect of this, because at the end of the day, we as your first investor, and we want you incentivized. We want you there. We want you to succeed. And you are key critical to our success. We're investing as much in you as anything. And so we want you to be incentivized. But, there's only so much we can do if there's a bunch of safes coming in that have a real dilutive effect on the company.
Nancy, from the company side, do you maybe this is something you don't want to die on this hill either, but do you sometimes say to the investor, which can be kind of an anomalous response, I know, investor, you think we need a 20% pool, but I'm the founder, I don't want to be diluted that much, so I'm going to start with a 15% pool because that should take care of senior management, should take care of the team, and I don't want to be diluted quite as much as I would be by a 20% pool. But I'm not going to need some of those options or restricted stock shares until a year or two down the line when I do my next financing round.
I think it's a really good question. In my first couple deals, I was very keen to, not do more than 15 or 16, but I learned very quickly that I ran out of options, usually because I hadn't planned who I wanted to incent. And I think John said it really well. The best incentive you have for recruiting is equity when you're at a startup. And that's what you want to build your team around, that people want to own that and, be contributing. So what I've started doing now is I map out everybody I think we need to hit our milestones and then put in a little bit of cushion so that I've actually got some math behind the numbers. If I know I need 15% of the pool to recruit, I'll ask for 17 or 18. So I've got a cushion because I don't like to run out, because then you've got to go back to the shareholders and, it's frankly a little embarrassing that you didn't calculate what you needed. So I like to lay it out and then put in a cushion. And I don't usually, for me, the option pool, that isn't something that I really would ever go up the hill or have an issue with my investors on, because I think that's just a rational discussion of what you need and have that available. For me, I'm much more concerned about voting rights, and especially if someone has a veto right, as an investor, because if your first investor has a veto right, you can imagine that Series B or C are going to want the same thing. And then you've got a lot of people you have to convince that you either want to sell the company or you want to go public. So I'm more concerned in those provisions. I also, because I've been diluted and I understand the process, and we're using, as I like to say, other people's money, I understand I'm going to get diluted. You know, I don't have 100 million myself to put in my therapeutics company. So I need to get that money, and that is the price that you negotiate. So I think John and I were kind of aligned on both of those. Those are two things that, you know, I would negotiate, but I wouldn't fall on my sword. I'm much more concerned about other provisions.
David, can you talk a little bit about staged deals? We've talked about milestones in the context of how you look at your financing and the future financing going forward. But in terms of deals and term sheets that actually contemplate, staging of investment and milestones, and what you're currently seeing and how that impacts how you think about valuation.
Well, a stage deal can be wanting to get a deal done and have more capital committed. And it can be a way to bridge the gap on an early valuation issue where you can have a step up in value in a subsequent tranche, subject to the attainment of milestones that are going to mean something in terms of reduction of risk and increase in value. I mean, one of the things that, in my opinion, folks don't think hard enough about is, why would pricing be different at a particular stage? It's all about what's been proven that reduces a risk or is an understood shorthand for some value created. So that's what milestones are about. And that's why talking about what you're going to accomplish with a given amount of capital makes sense. The investor's job is to expose the least amount of capital to a particular risk to get to a step-up point. And so if you think about the milestones that way, then it can make sense. I mean, I'm not a big fan of, I think there is a big element both in negotiating a term sheet, getting a deal done, and in just doing business, the keep it simple rule. But it can be a way to get past a hurdle where the investors just can't get past a particular valuation for a particular tranche, but will feel a lot more comfortable about exposing another chunk of their capital to that company as long as milestones are achieved. And it can be two issues. One is, it's not always a valuation step up. One, it can be, is a particular amount of capital going in, and then is a subsequent amount going in. And then you get into a negotiation of what the milestones are. From the company's perspective, it can be a dangerous game if you have any ambiguity about what the milestones are and what the accomplishment of milestones constitutes. Because if you get there and there's any question about whether the investor has the right not to put the money in, then you can have a very difficult situation, either of running out of capital or being put out of business, or taking that capital at a step down. So I think it can be a very double-edged sword, and it varies by what's going on at the market at a particular time.
If I might just add something there, Mark, I think it's important as an entrepreneur, if you're taking money from a partner that you're going to be sharing risk with. I don't like to do tranche financings or, milestone based. I think it's better to just give up some of the ownership. If it's only on valuation, I would just give it up and get the money so you can execute. Um, the one time that I did do a tranche was we needed to have a pre-IND meeting to get agreement on clinical strategy, which was a huge risk, right? And that was very definable. But otherwise, I personally, as an entrepreneur, I'd rather take the cash you need to execute and just give up on the valuation. That's just
Yeah,
my
Yeah.
I would just add to that, sometimes some of the most shocking advice I think entrepreneurs walk out from our meetings with our partners is we think you should take less money at a lower valuation. And I know from an entrepreneur's perspective, I want to raise as much as I can at as high value as I can. And again, from our perspective as First Money In, we're going to be partners with you along the way. And we want to see that stair step each and every time you go out. And it doesn't look good when a company oversells itself and raises a ton of money at a high value and isn't able to execute, or it's able to partially execute on that. So, our philosophy, not always, but usually, is if you take less and at a lower value, there's not as much dilution to the founding team, but put every dollar to work and hit that milestone. So you have a 3x valuation jump when you go from A to B, as opposed to a 10% valuation jump because you raised a ton of money, or you have to do a step down round. It will set you up. Much, much better. And again, talking about aligned incentives, if the value of the company goes up 3x, like the value of our first investment goes up 3x, we're happy that we put in less money at that value.
Yeah. And, the other thing that sort of getting, this is about term sheets, but a cautionary note to entrepreneurs who raise that early capital, friends and family, and some people call it friends, family, and fools. There can be, some, to put it nicely, fuzzy math around valuation at that early stage. Okay. And you can feel like you've done a great job because you've persuaded some angels to overpay, and don't go into a negotiation with your first institutional investor and say, well, but my dad told me he'd give me this valuation. Okay. You got to have that uncomfortable conversation with dad saying, hey, thanks for the money, or Uncle Harry, or even a reputable angel. But you got to have that conversation that, no, that, that value that we had early on, with your having all sorts of anti-dilution protections, that's not sustainable here. So that's why it's really a good mechanism to use something like a convertible note or a SAFE. Because, having crazy early valuations can really set you up for failure.
So we can come back to valuation if others have questions. I want to move on to other terms in the term sheet, although we do have a question here that I'll stop for early stage companies raising money not through a price round. What is the sense of the split between convertible debt typical debt to equity notes versus safes? And I don't have empirical data from the investor perspective. I prefer generally, and John may have his own perspective on this, to have a convertible note where you've got a fixed term, and at least theoretically you've got the right to get paid back what you lent if the note doesn't convert. Of course, if the note doesn't convert, that may be bad news about the company's ability to pay you back. But that's kind of how I look at it. But empirically, in terms of the split, safes are, they've been around for a while now, but they haven't been around nearly as long as convertible notes. And so I probably still see more convert bridge notes than safes. But Aroma, you may have a perspective, or John, or others.
Yeah, I'm happy to. Go ahead, Aroma.
I was just going to address the part of the question that asked about geography, because I do think that there's this idea that, given that safes kind of started here on the West Coast, that it's really used by West Coast investors. But I just wanted to note that I have been seeing them used increasingly more with investors in the Midwest, or especially out of Boston. I don't think that it's a Silicon Valley thing anymore, was all I was going to say.
Great. Yeah. And I think from my perspective, as the lawyer at heart, the convertible note, for the reasons Mark said, are probably better for an investor, but overwhelmingly at the business level, the use of the safe, the ability that you can go pull it off the internet, and you can run a quick compare to see what the terms are. It's largely agreed to by everybody. It's quick. There's no haggling. Even though convertible terms are pretty universal, I would say most law firms and or service providers or the NPCA or whomever have slightly different but close to the same forms. And so it's more of a negotiation. Whereas, two business principals can pull the safe off the internet. They can send it to the lawyer and say, does this look good? We're not changing anything. And their lawyer gives them a thumbs up and they move on with it. So I prefer the note, but I think the safe is proliferating for that reason.
Yeah, I would echo that. I prefer the note from the investor's perspective because and frankly, I think it is less complicated in the sense that the note preserves the investor's spot in the capital stack. It's tried and true. You can put in a valuation cap, but they're functionally so close to equivalent. Either way, you can't make a bad decision if you're doing one. And as John pointed out, you can pull both of those off the internet and do them simply.
Another question that's popped up here in Q&A, where is a no-shop term acceptable? Is it legitimate for the investor to ask for this? I think it's certainly legitimate for investors to ask for it. The idea is at a high level, the notion is there's been an agreement on the economic terms of a deal. There's probably been some preliminary due diligence done by the investor. Almost certainly there has been, but they haven't dove in all the way. They need to do some additional due diligence, and the investor, and obviously there's going to be a negotiation of a definitive agreement. So from the investor's perspective, I don't want to really go through all of that if you're just shopping my term sheet to other other potential investors. Just talk to me for the next 30 days or 45 days or 60 days, and if we don't reach a deal, then you can move on. And if you have other investors that you want to bring in, I'm happy to talk to them. But so I think it's legitimate for an investor to ask for this. Nancy, do you generally push back on no shops, or do you kind of accept them?
It's a good question. It depends on what the process is with my potential partner. Some venture firms I have found do, at least in life science, do a fair amount of diligence before the term sheet. So typically there's very little left, maybe IP, not much left. In that case, I don't hesitate to sign them. If it's someone who hasn't done any diligence at that point, then I usually say, take a couple weeks, see what you need to do for initial diligence, and then we can execute something. I just want to make sure that when I take the company off the market, that the potential investor is a pretty good shot to close, because I've never signed a term sheet that didn't close, so I don't want to start now.
Yeah, and that's a fair point. I think perhaps more so than in M&A deals, when you sign a term sheet in a VC deal, the likelihood of closing is probably higher. In an M&A deal, I think more deals go bust than in a financing. But John and David, your perspective on no shops?
Sure. So I think there's two for entrepreneurs key critical dates, and I just did a term sheet that I sent to one of our partners before this call. So there's an expiry, meaning if we send out a term sheet today as an example, and it expires Friday at 5. So, and it's up to the entrepreneur to sign it, and then there's a 45-day exclusivity in it. Now, between now and Friday at 5, I'm expecting they're going to go knock on every door they can up and down Sand Hill Road, trying to match or best our deal. But if they're unable to, or they want to go with us and they sign, we do expect we're going to undertake cost, and we're going to undertake business diligence and some IP diligence. And so we would expect that the company, with respect to a financing, not a sale, but a financing, would sit on their hands for the requisite period of time and just negotiate with us. Absolutely.
So do you not put a confidentiality undertaking so that they're not shopping your terms?
We do, but it's unsigned, right? If I send across my term sheet and it's unsigned, I think of it like the employee context, right? If I get an offer from a company and it's maybe signed by the CEO, but I haven't countersigned it, I can go back to my employer, whoever else, and try to get a better deal. until it expires.
So I know we've got one or two other questions in the Q&A, but let's talk about first some of the other key terms in a term sheet that go beyond valuation, anti-dilution provisions, liquidation preference, participation rights. Aroma, do you want to kind of run through some of those at a high level?
Yeah, definitely. And I'll just touch on some of the terms that I feel are more heavily negotiated, but feel free to ask if I'm missing something that you want to talk about. So I think number one is always liquidation preference. This determines who gets paid out first in a liquidity event, which includes not only M&A events, but also dissolution of the company. So generally, or I should say always, preferred holders are going to get preference over common stock at payout. And then there's a determination of whether or not preferred holders are going to be participating preferred. And this essentially determines whether or not investors will have their cake and eat it too. For participating preferred, investors receive the preference amount, which is usually the price per share over common stock. And then they also participate with common holders for the remaining proceeds on a pro rata as converted basis. So essentially they get 2 bites of the apple. Another highly negotiated term I feel is anti-dilution, which addresses essentially the downside of a company. It's the mechanism to reprice the stock to protect an investor's position. So the adjustments are applicable to subsequent equity issuances at a lower valuation than that is paid by the investor. And where this can generally be negotiated is that these adjustments can be calculated on a weighted average basis or full ratchet. And full ratchet is more investor friendly. I won't go into the details of the calculation, but this adjustment generally results in a more pronounced decrease in conversion price, which means a more the proportionate increase in conversion ratio, as opposed to broad-based weighted average, which is more company friendly. For dividends, the only thing I wanted to note is that it's really rare for early stage VC-backed companies to pay dividends to stockholders. So this is generally not something that's heavily negotiated, and I think we sometimes see entrepreneurs that want to negotiate this point, but I think especially for your Series C, A, and B rounds, it's not something that is really addressed. And for voting mechanisms, so there are usually protective provisions for certain preferred classes of stock. This is essentially a separate voting right for preferred holders on special issues, such as whether or not the company is going to undergo an M&A event, or whether they're going to participate in future rounds of financing. On top of that, there may be specific veto rights for particular investors, which I think Nancy kind of noted earlier. And these veto rights can be in the form of essentially like something along the lines of the Series A holders will need to vote to approve a future M&A event, which vote shall include, the approval of Coastal Ventures or something like that. And board seats, which is another key term for control of the company. It's a question of how many board seats will your preferred holders get, and which investors will hold those seats, as well as board observer rights, where board observers will attend meetings and have access to all the board materials, but they don't actually sit on the board. They won't be voting as a director, and similarly, they won't have any fiduciary duties. So this last part in particular, especially for early stage companies, you might see some investors prefer just to have a board observer seat very early on and not necessarily a seat on the board if they want to avoid having those fiduciary duties.
Aroma, maybe we can pause there. Let me
Yeah.
turn to Nancy. And Nancy, how do you look at calibrating board size and granting board seats and observer seats to investors in the early rounds of a company's finance?
So the way I try to keep it simple. So early on in this Series A, I try to not have more than 5 board members, right? And I like to do syndicated deals. So typically it would be 2 investors, the sitting CEO, and then either one of the founders. And then I like to have an independent board member on early if I can as well. So, and from observer rights, I found as an entrepreneur that giving them out has been very valuable to me, and I like to have observers. So because they're not voting, but if the more they know about your business and what's happening, I found they bring incredible value. So if people want observer rights, I've usually said yes. Now some of those I've put a caveat that they have to their firm has to own X amount in the company or something like that to maintain the observer right. But I like having observers because I think the more people at the table, the more value you get as a CEO. Yeah.
John, in what circumstances does the venture capital investor, want a board seat versus other circumstances in which the investor will forego the board seat and say, I prefer to take an investor role, partially for perhaps the reason that Aroma alluded to, which is you can avoid fiduciary duty problems?
Yeah, I think that, again, just in speaking in very rough terms, we tend to think about board seats based on percentage ownership of the company, right? So if we're the first investor in and we're owning 20 to 30%, we'd probably expect to take a seat. If it's less than that, maybe we wouldn't, and we would just take an observer. I think what Nancy brought up is a very interesting point, in that I know a lot of times entrepreneurs can say, well, if I have like 5 observers, my gosh, I'm a small company. I'm gonna have 11 people in the boardroom. It becomes unwieldy. It could, but these oftentimes are people who bring a lot of perspective. And in terms of giving something to your investors when you're negotiating, they love observers. Investors always want an observer right. And so handing them out, whether they end up using them or not, or sending somebody or not, and if they end up sending somebody who is not helpful, well, it's one more body in the room that's drinking your coffee and eating your croissants. But that is something, just in terms of term sheet negotiation, it's a pretty easy give that I think you can give that will curry favor for you when you're negotiating with investors.
And in the remote world, you're not buying as many croissants anyway.
Exactly.
So. David, Aroma mentioned the desire to have a veto right over major decisions by a corporation, kind of protective provisions, class voting rights. There's a desire to have that on behalf of investors. I'm sure John would agree. But how is that balanced against, from the investor perspective, the concern that if there's too many folks that have these veto rights, this company is going to be hamstrung. So I, as an investor, might not be able to actually realize ultimately the returns that I want based on other investors who are overly conservative or have a different perspective.
It's a great question, and there's a technical aspect to it, and there's a sort of almost cultural or philosophical aspect. One thing before I forget to point people to that, to take you through some of the mumbo jumbo of a term sheet, I would strongly recommend taking a look on the NVCA's website at their model term sheet, because it's annotated and can give you a little bit of explanation of what each of the provisions is and means. But just as an aside, yeah, I mean, the investors have a legitimate right at, vetoes and other protective provisions to make sure that there's an appropriate sale process and certain other things that protective provisions are around. But I think you need to and this is, in some senses, it's up to investors to clean some of this up round to round. So if you've got some crazy stuff that is a carryover from different points, and a responsible investor should bring up in a negotiation, cleaning up some of those differential rights that may cause dysfunction at a later stage. But the philosophical element is, what's the relationship with your investor, and what's your relationship with the board about? A board should not be about investors there because of their ego, or there because of their just babysitting an investment. Now, investors have a legitimate reason to understand and monitor what's going on at a company and hold the company accountable. But if a board is not functioning by consensus, and if when the management team thinks it's time to exit, that CEO can't drive that consensus, and it's a matter of an investor vetoing, that's a big problem. So in how you're thinking about your board, to whom you're and how you're building your board. I mean, Nancy alluded to the fact that, yeah, you want 5 early on, and which is sound judgment. You want outsiders, not just outsiders for independence, but as you're composing a board, it's important to think about what people are adding to the entrepreneur's journey and the entrepreneur's basket of resources, what the quality of the dialogue is, because you're in real trouble if the decisions at the board level are about counting votes. They need to be about driving consensus, having good conversations. It's got to be safe to disagree about things and then air out the disagreement. And so part of that also goes to the selection of what investors' money you're taking, whose term sheet you are taking, what diligence they're doing about you, and what diligence you're doing about them.
Great. A couple of questions on the Q&A, and there are additional terms on the term sheet that we may come back to if we have a minute at the end, but covering things like registration rights and potentially mandatory redemptions, but and some that aren't necessarily invoked quite frequently, but we can come back. One of the questions is, tell us about board compensation for early stage companies. In general, my experience is that board members who are represented and observers who are representative of investors, venture capital firms, and others are not getting separate compensation. But to the extent that there are an independent, Nancy said she likes to have an independent on the board if she can get one early on, which makes a great deal of sense. Then some kind of compensation and other independent observers, perhaps, and advisors, some kind of compensation is going to be part of the game. My general view is that for an early stage company, that's going to be in the form of equity rather than cash. But Nancy, do you have any perspective on that?
I have your perspective, which is cash is king, so I give them equity. Yeah, but no cash. And obviously, if they're traveling, you would reimburse their expenses, but we don't pay them to be on the board other than giving them equity.
John agreed. No, for a VC fund representative, no comp.
Nope, no comp.
Yeah. And Nancy, one of the other questions in the Q&A relates to due diligence. And I think I'd like to get your perspective on this. And David alluded to this as well, which is about the due diligence processes are fully transparent from both sides. And so, clearly the VC firm is going to do a lot of diligence. And as you said, hopefully has done a significant amount of diligence in advance of signing the term sheet. So you have a good sense that they've got a good level of comfort. But you want to talk a little bit about the diligence process that that you go through as the CEO and kind of the trip to the dentist there, and then what about your diligence on the potential investors?
Right. So I think on the diligence side for entrepreneurs, it took me a while to appreciate this, but you want to do your diligence on your partner because you guys are going to be in this for years together unless you get a quick exit after 2 years or something. So I do a couple of things. I usually look at the potential lead investor and all the people in their syndicates, which means every fund they've invested with, right? Because I can then talk to VCs I know at different funds and get an impression from how are they to work with. You guys have invested with them before. What are some things I should be aware of? The other thing I like to do is I like to call both current and previous CEOs that have worked with them, and just get their opinion on how does the fund work, and the particular partner that I'm working with, any comments there, or how helpful were they, did they extend their network to you, those kinds of questions. So I like to do my diligence as well so that I pick the
And then
right
in terms of
person.
the diligence performed by the investor, again, you're trying to, it sounds like, push some of that actually to the term sheet stage, and you'll do that under an NDA presumably.
Right.
Although some venture capitalists are a little bit more reluctant than others to sign NDAs, at the front end.
Right.
But then, is it kind of open kimono from the beginning, or are you staging from time to time, based on progress on the deal, what you provide and when?
So I usually set up the data room from the very beginning with everything that I know they're going to want. And when you're starting a company, you need to, get someone to help you, a CFO that's done this before, so that you keep really good records. But I tend to wait for the critical things, particularly IP, until I know that they're really serious. And sometimes that has been even before we signed the term sheet because we did an NDA. But I would say my experience is about 50% of the funds will not sign an NDA, right? So I kind of wait on the IP usually. The financial models and things, the early proof of concept, I think that's good to get. In market data, they can get that too. But for them to think about how are you thinking about the market and how does your solution play against other competitors and things, I like to do that at the beginning. Yeah.
So we're bumping up against the end here, David. I think we've hit most of the Q&A questions. Any additional nuggets of advice for management of early stage companies as to how to deal with prospective investors at the term sheet stage?
Get good advice, and listen carefully. It's not an exact science, and it really does help define your relationship. If you are going at each other hammer and tongs on a term sheet, you need to be careful with that, because you're defining your relationship, and people have long memories. And so go at it like you're working something out with a partner. And if there are issues on which you're willing to blow up the deal, be mindful of those. And if there are certain, but be strategic about how you do it and enjoy the process.
Great. Well, I think we've hit the end of our hour. I want to thank the panelists. I thought the discussion was outstanding that you folks undertook, and I think we've hit all the questions. So, Greg, unless there's anything else, I think we're going to adjourn here.
Thank you, everyone. I think we're good.
Thanks to all the participants for listening in, obviously.
Thanks a lot.
Thank you so much, everybody.
Bye.
Thanks, everybody.
Bye.